This is InvestTalk. Independent thinking, shared success.
Hi, this is Dennis. I'd like to know what you folks think of Prologis, PLD. It's about a $120 billion company, and I sure would be interested in your opinion. Thank you.
Prologis, ticker PLD, is a massive, massive REIT. It is a REIT that specializes in logistics facilities, so the industrial REIT space. They have industrial properties across the Americas, across Europe, across Asia, all over the place. And you can see that the revenue, though, is focused primarily from properties in the United States. It's not just manufacturing, it's also retail, it's also e-commerce, various industries within the industrial space. Now, recently, year to date, the stock is up 13.31%. Now, in the past year, it's down 9.3%, but we know it was a shaky year for REITs in general. Even though it was a shaky year, it still underperformed its industry by 21.5% in 2024. Now, this year, it's outperforming its industry so far by about 10.6%. So why is that? Well, in the fourth quarter of 2024, they reported net earnings per diluted share of $1.37. That was a 101.5% increase from last year. Their funds from operation per share reached $1.50, up 19% for the previous year. And they've been executing an acquisition strategy for several years that have made them this behemoth of a REIT company, including the largest commercial real estate transaction in the U.S. since the onset of the pandemic, when in 2022 they acquired Duke Realty for about $23 billion. Now, they have quite a bit of debt, but most REITs will. Now, honestly, it's not that much debt, about $30 billion in debt. They pay a solid dividend, about 3.15%, which is higher than it has been over the past 5 years on average, but still not a worryingly high dividend. Now, price relative to their funds from operations in about 21 times, still below their 5-year average. Price to book value still below their 5-year average as well. And so over the past year, the reason why this name is down is because industrial demand is down. Demand for industrial property is down. But what they outlined in their most recent earnings report, which came in January, was that they see demand picking up this year. And they see demand picking up this year, and they'll put their money where their mouth is by continuing to acquire companies and properties. And so the uncertainty within the REIT space is primarily predicated upon where rates are going. REITs tend to do well when there is a certain rate path. Now, inflation seems to be a little stickier than it has been, or than some would have liked it to be. That is one of the reasons why this name is down 1.64%. I would say, going into the end of February, until we get some clarity on the Fed's preferred metric on inflation, PCE, REITs will probably be volatile. Should that not complicate the picture by backing up what CPI said? Well, maybe it is a good time to invest in REITs. I think this is a good company. I think their acquisition strategy has been great. I think their growth is fantastic. I just think the next couple of weeks may provide some clarity towards the path of rates for the next 6 months. And so for now, I would keep it on my watch list. But when I am comfortable buying REITs, I think PLD is a good one to buy. Thanks for the call. I hope you've been telling your friends and family members that not only can you listen to us on podcast form, but we do put this on YouTube. It's not exactly the same show. We do it a little bit differently. We segment what we're doing, the caller questions, the focus point, the market update. But either way, if you want to get your information on YouTube, we do have a channel that is InvestTalk with 2 T's. And when you have a question and you don't feel like calling in, you can just leave it right over there in the InvestTalk YouTube comment section. We'd like to get to those as quickly as we can. So let's tackle one right now. It says, what's your opinion on AVB looking to increase my REIT allocation? Well, obviously, we've already been talking about REITs a little bit and what has driven them downward today. AVB is Avalon Bay Communities. It is down 51 basis points today. Like most REITs, again, uncertainty within the path of rates is what's going to drive them down. Now, Avalon Bay Communities is a REIT specializing in the development and acquisition of apartment communities across the United States. As of the end of January of 2021, they owned 80,000 apartments. Now, it's a fairly good size REIT. It's about $31 billion in terms of total market cap. It's got about $8 billion in debt, so not too much debt there. Its cash flow looks pretty solid. Its profitability looks solid as well, as does its revenue growth, about 5% annualized over the past 5 years. Now, taking a look at financial results. On February 5th, they announced its 2024 operating results, and the company declared a quarterly dividend of $1.75 per share. So that is an increase. We have seen dividend increases pretty consistently over the past 6 years, something we do like to see when we have REITs, right? The whole point of investing in REITs is to maybe hedge against inflation with real estate, but primarily as an income producing investment. And so the dividend yield right now sits at about 3.2%, which is where it's been over the past 5 years. Now, from a relative valuation perspective, it's sitting about 18.9 forward-looking price to funds from operation, a little bit below where its 5-year average has been. It's nearly flat on the year, down just about 1% at 99 basis points. Over the past 3 months, it's down 5.39%. On the 52-week period, it's actually up 24.91%. So it did outperform the rest of the industry in 2024 by a good amount, about 16.7%. And so this, to me, seems to be another situation. I like thematically, one of the biggest problems facing this country is inaffordability of housing, which means the likelihood of investment going into building more apartments, building more homes, could stand to benefit from these REITs that have experience buying up this property and managing this real estate. And so with that being said, I think that AVB is a solid investment choice, but I still worry about some of those overarching dynamics that are pushing the real estate market down as a whole. But this company is focusing and doing a pretty good job of focusing on high demand urban markets and the strategic development of, again, areas of the country that need housing more than ever. So similar to the last question we answered on Prologis, I would say that the next couple months are going to, or rather the next couple weeks, may show a lot about whether or not this was a flash in the pan inflation number, whether or not the hawkish repricing of a Fed interest rate cut was justified, but overall give you more clarity on how the REIT space may move over the next several months. So for now, similar to the other name, I would keep AVB on my watch list. I don't see anything wrong with it specifically. I just think that now might not be a good time to get into REITs. Thanks for watching. Looks like we have a live call. Chris from Maine, who has a question on POWL. I won't be able to answer it, but maybe you can get your question in now and we can answer it after the break.
Yeah, hey Luke. Thanks for taking my call. So it's actually a stock that I used to own. I got in around 120, and then it started jumping up. I sold half my position at 180, and then it got to the low 200s, and I completely cashed out. Watch it go up into 300. Now it's kind of working its way back down. So I was just curious where you guys, what you think of the company and where you see a good support level to re-enter a position.
Okay, so just that I get this clear, you originally opened it at 120, you sold a little bit at 180, cashed out around 200. Now you're trying to get back in.
Yeah, exactly.
Okie doke. Well, POWL Industries, it's a U.S. company. It designs, manufactures, and services custom engineered equipment and systems for electrical energy. Their products include integrated power control room substations, medium voltage circuit breakers, and a whole bunch of other things that primarily help electrical utilities, mining companies, oil, gas, and petrochemical companies. And, that's loading on the wrong company. We should probably look at the right company if we're going to answer your question. But it's a $2.5 billion market cap company. It has very little debt. In fact, about as little debt as you can possibly have. $1 million on a $2.5 billion market cap company. Just a little highlight of the top line of the company. We will dive in more when we come back and answer Chris's question. So before the break, we were going through Chris's question on POWL, POWL Industries. And we mentioned it's a $2.5 billion market cap company. It is down almost 40% over the past 3 months after having a huge surge in 2024. It was up 150% in 2024 and 151% in 2023. So certainly a pullback from a stellar consecutive 2 years. Now, looking at a financial perspective, interestingly enough, they did report earnings on February 6th. You can see right here that The earnings per share actual 2.85 relative to 261. So you had a 9.4% positive surprise on the bottom line, and even had a 3.8% positive surprise on the top line. But year to date, it's still down 5.51%. Now, some of that is some consolidation after pulling back from some pretty obscene highs over the past 5 years, right? Look at this forward-looking price to earnings for an industrial company to have an average over the past 5 years of 78%, or rather 78 times. That's incredibly high. Now it's at a more reasonable number, about 15 times forward-looking earnings, 5 times book value. Still high, in my opinion, but not as high as 10 times book value, where it stood at one point in the past 2 years. But it's still trading at 41 times cash flow. Now, I think what is driving this name down is, as I mentioned, some pullback after a stellar 2 years, but also the fact that the demand for power generation that we saw in 2023 and 2024 in the wake of the battle of AI companies is kind of receding a little bit. Not completely, but a little bit. Forward-looking guidance wasn't as good as one was hoping for, and so you do see a pullback from there. Now, I still do think it's a good company. Again, this is a company that has had a lot of demand over the past 2 years. It's surged. It's still small cap, but it's surged. Pays a little bit of a dividend, about 51 basis points, but more importantly, it has no debt on its balance sheet, and it has pretty stellar cash flow improvement with the exception of last year, and its profitability is still solid. Its net margin sat at 14.8% last year, the climb from several years ago at only 10 basis points, and it's projected to be steady at 14.9% this year. So overall, I think it's a solid company that is having a necessary pullback. In terms of an entry point, it looks like it pulled back below its support at about the 215 level. It could head back down to 150. I would think when it gets down to maybe about 160, 170, that's where I would look to enter. It still looks a little bit expensive to me if you're looking at its price to book value. So I think it probably still has some room to run downward before I would think about getting in. Thanks for the call. Looks like we have another live call. James from New York, who has a question about CRI. Do you own it or are you looking to buy it?
It's on my watch list, but I noticed the chart. It's been sloping down for a long time, a very high yield. Is this a value trap, perhaps, or is this worth just moving on and not getting a position into?
Well, let's take a look at CRI, which is Karcher's Inc. It is a business of young children's apparel. It has several segments in the United States, wholesale and international segments. Geographically, most of its revenue comes to the United States, though not all of it, about 85%, then another 9% from Canada. So we could say an overwhelming majority of its revenue does come from North America. Now, it's a $1.9 billion market cap company, so it is a small cap. It's got about $1.1 billion in debt, which is a red flag right there. But its interest coverage ratio, which again is EBIT relative to its interest, so how much of its income before interest and taxes can pay its interest expense, is about 9 times. So it's not overly levered from that perspective. Now, you did mention a 6% dividend yield. That is more than double its 5-year average. Back in 2020, its dividend yield was 1.2%. The highest it's been, other than right now, in 2023, it was 4%. Now, its dividend per share has been growing, but it's also bought back shares. It's bought back a lot of shares. It went from 45 million in 2021 to 35 million in 2024. So a lot of that growth in dividends per share is not actual growth, but rather just because shares have been bought back. Inherently, if you have fewer shares and the same amount of earnings, and you have the same dollar value dividend going out, well, then you have higher dividend per share. And so the reason why this has pulled back 36% in the past 52 weeks is because cash flow is headed in the wrong direction. Profitability has been pretty stagnant for quite some time, right? They reached a peak back in 2021 during the pandemic, and it's been steadily falling ever since. Similarly, in 2021, they had a peak revenue, about $3.4 billion, and it's been steadily falling ever since. In fact, they report earnings March 3rd, so coming up in a couple weeks. The revenue is supposed to fall from last year, and next year it's projected to fall as well. And so as you'd expect from a relative valuation perspective, it just keeps heading downward, trading at 10 times forward-looking earnings now, just below its 4-year average, or rather 5-year average. As you mentioned, it's in a downtrend. It's in a definite downtrend. In February of last year, it was trading in the 80s. Now it is trading in the 50s. It's down 2.19% today. It has a consensus hold rating. I think the short, easy answer to your question is that it is value trap. The market has 15% short interest out there. So although it's fallen, a lot of people still think it has a lot more room to fall. So I'd stay away for now. Thanks for the call. Now, we've mentioned it a couple times already today because, well, it drove REIT prices downward, and that's inflation. And that's because consumer prices surged in January, and they also dashed hopes for the Federal Reserve's rate cuts in the near future. The Labor Department reported a 50 basis point monthly increase, the largest since August of 2023, and higher than economists' expectations of 30 basis points, significantly higher on a relative basis. Annual inflation rose to 3%, up from 2.9% in December, and so markets reacted pretty swiftly. Stocks fell, bond yields rose, as investors are starting to adjust their expectations and reprice the path of rates. But more than anything, the spike in inflation, the unexpected spike, complicates policy. While President Trump campaigned on lowering prices, economists warned that his new import tariffs would do the opposite. They could fuel inflation further. Now, his administration argues that deregulation and increased energy production will essentially counterbalance the rising goods prices, but in reality, the overall impact remains uncertain. We talked about this at the beginning of the administration. There is an order of operations to which things can happen. Some things can happen unilaterally quickly. Some things take legislation and time to feel the effects. Now, January's price increases were driven largely by used cars, auto insurance, and eggs, which soared 15% due to the bird flu outbreak. Core inflation, excluding food and energy, rose 40 basis points, its highest monthly gain in nearly 2 years. And what that did is it pushed the annual core rate to 3.3%. Interestingly enough, housing and rental costs, which before were the primary drivers of inflation, weren't really to blame this time. Instead, these pressures have really broadened across goods and services. Now, the report has, I would say, some pretty major implications for monetary policy. The Fed's preferred inflation gauge, PCE, stood at 2.6% in December. Now, that doesn't sound as bad as 3%, but it's still higher, still above the Fed's 2% target. Fed Chair Jerome Powell reiterated that policy must remain restrictive, suggesting no imminent rate cuts. And in fact, as we mentioned already, the market now not expecting one until December. And additionally, interest rate futures are indicating a growing belief among traders that they might not cut at all. Odds rose for no rate cut in 2025 from 20 to 30% in just a day. And one thing that adds another layer of complexity is the president's economic policies. While his election initially boosted business confidence, concerns are mounting over rapid tariff hikes, executive orders. A small business survey showed that the post-election optimism faded pretty significantly in February. Tariffs are likely to push inflation higher in the coming months. Historical data actually shows the previous tariffs, such as the 20% levy on imported washing machines in 2018, led to nearly 1-to-1 price increases within 3 months. This new 10% tariff on Chinese goods may have a similar impact by March or April of this year. In reality, January has now seen some pretty outsized price hikes for 3 consecutive years, making it harder for inflation to trend downward. Fed officials, including Dallas Fed President Lori Logan, have warned that another turn-of-the-year price surge signals the need for tighter monetary policy. As inflation remains stubborn, the Fed may hold off on rate cuts longer than markets initially expected, and we may be just seeing the beginning of markets pricing that in. Looks like we have live call number 3. Our friend Bill from Northern California, who's asking about TROW and listening on AM 1220. Do you own it or are you looking to buy it, Bill?
Both. I own it, and I'm looking to add more, possibly. I've bought and sold it. I've kept a core position down in the mid to low 90s, as a dividend stock, and waiting for the company to recover, some of their earnings, probably, I hope. But if it goes up, I'll sell some shares and then buy some back when it dips. At least I get some circulation out of it that way. But do you see their current price and the PE reflecting just, the profit margins currently? And would you anticipate them going up in the next year or two and therefore getting a price increase maybe into the 130, 140 range?
Yeah, well, that's a good question. So taking a step back, TROW, it's an investment management firm. TROW Price, it's a very large firm, about $24 billion market cap. And as is always the case, profitability is driven by two things with these types of companies: assets under management and fees. Now, you have seen some revenue growth over the past couple years, but the trend of that is starting to fall off a little bit. And so over the past 52 weeks, when the market is up significantly, TROW's down 2.79%. They've underperformed the S&P 500 since 2022. They've underperformed their industry since 2021. Year to date, they're down about 5.46%. Cash flow is headed certainly in the wrong direction. Profitability has started to fall as well. But I mentioned it before, right? There are two things that drive this: assets under management and fees. Now, the latter, fees, are being driven down across the board. Active ETFs that operate with a lot of efficiency have driven in a lot of inflows, net inflows from retail investors. And low fee has been for some time the way of the future. And so fees are being driven downward. Therefore, the only way to have profits in nominal terms grow for an asset manager is to increase the assets you have under management. There's two ways to do that: be good at investing, bring in new money. Well, they've been okay at investing, but they haven't been bringing in new money. They've actually lost assets under management over the past couple years. It's been falling. Now, they still have $1.6 trillion under management. That is still a lot of assets, but it's still falling, and it doesn't seem to me like they've been able to stem the tide of that. Now, they're trading at a forward-looking earnings in about 12 times, price to book about 2.4, which is still kind of expensive for an asset manager, if you ask me, but not crazy expensive. I think one of the issues is, and the reason why they continue to underperform, is because they haven't been able to compete on reducing fees, and they haven't been able to compete, therefore, on bringing in new assets. And I just don't see in the near future any catalysts for that trend to subside. And so for me, I think there are better opportunities out there, especially within the investment management space. I mean, look, they've underperformed their industry over the past 5 years by 11%, 17%, 21%, 21%. I'm sorry, that was 31 last year and 5.3 this year. So frankly, I think there's better places where you can go if you're looking for an asset manager than T. Rowe Price. Thanks for the call.
All right. Thank you.
Have a wonderful day.
Bye.
Let's see. Do we have time? Yeah, we got plenty of time. Let's keep things moving and pivot back to the InvestTalk voice bank. You know the number, even though I can't talk right now, 888-99-CHART.
Hey, this is James from Georgia. I read about a company on Tip Ranks, which is an app that I have, putting me on a stock called Nightscope, KSCP. And this is a company that it's created a line of autonomous security robots. It's in that field, and it's for security. Anyways, it was recommended to me. I was hoping that you could take a look at this. Love the show. Thanks, guys.
Well, that sounds scary, but let's talk about it. KSCP is Nightscope Inc. They are developing security technology solutions. It includes the K1 stationary machine, the K3 indoor machine, and the K5 outdoor machine, as well as the K7 multi-terrain four-wheel vehicle. My first thought here is, what about the K2, 4, and 6? Apparently they only like odd numbers, but that shouldn't really tell you much about how their stock price is performing. Now, what does tell you about how their stock price is performing is a downward arrow, because over the past 52 weeks, they're down 64.52%. And they issue a bunch of shares. They are a small company. $41 million market cap company. I'm going to make this one short and sweet, not because we're going to a break, but because it's a really easy one to answer. The revenue's grown a bit, but they are not making any money. They are in the negative hundreds in terms of their net margins. Their cash flow is pretty flat. They have very little debt because they issue a bunch of shares, and it's too risky. $41 million market cap. So on KSCP, the scary robot company, Nightscope, gonna have to pass. Looks like we got time for one more question, so we'll dip back into the InvestTalk YouTube question bank and answer this question on GCT. It says, what are your thoughts on GigaCloud, ticker GCT? Seems like the technicals might be getting stronger. Well, GigaCloud is an end-to-end back business-to-business e-commerce solutions company. They deal primarily in large parcel solutions. They operate in the US and Asia and Europe. So think furniture, fitness equipment, home appliances. That is primarily their business. Now, it's an $832 million market cap company. It's got $504 million in debt, so quite a bit of debt for the small, bordering on microcap name that it is. Its cash flows improved pretty significantly over the past 3 years, as has its profitability. Its net margins grew from 4.7% in 2022. 13.4 is where it landed last year, projected to be 11.1. They do report earnings on March 14th, so we'll certainly see that soon. So it has slipped off a little bit in the past year. But sales growth has been pretty stellar. Look at 2022 to 2023, 490 million to 703 million. That's incredible growth. Projected to be about 1.1 billion this year. It also looks very cheap, about 5.6 times forward-looking earnings relative to its average over the past 5 years of 8 times. Price to cash flow about 6 times. Price to sales only about 0.8 times. Price to book 2.1 times. So it looks pretty cheap on a relative valuation perspective. Now, they have issued a little bit of shares, but not too many shares outstanding, I would say. Or rather, not too many shares, I would say. From a technical perspective, maybe it's strengthening. Maybe it found some support at 20, around there. 17 to 20, but still looks pretty weak to me. It's been on a consistent downtrend since February, and nothing that really shows any change, right? You're not seeing any pickup in volume here. You're actually seeing diminishing volume here. So maybe you don't see any capitulation at all. Over the past 3 months, they're down about 14%, past 52 weeks down 38%. Maybe it's because they've had a lot of insider selling in December 2024, which tends to not be a good thing for the prospect of the business if the insiders are selling a lot. But the market also thinks it's still too expensive. 18 times is what its short interest is. So maybe if you're looking for a short-term trade that this thing may squeeze if earnings are great on March 14th, it may make sense for you. But otherwise, gonna have to pass. Thanks for the call, or thanks for watching. Now, the Trump trade bets on a stronger dollar and higher bond yields have really faltered this year as investors reconsider the economic consequences of the administration's trade war. Despite initial expectations that Trump's tariffs and tax policies would push inflation and interest rates higher, dollars weakened and the treasuries have rallied since early January. Many traders are now reassessing their positions. Investors had initially positioned for a dollar rally, anticipating that tariffs would drive inflation higher while limiting the Federal Reserve's ability to cut rates. But in late 2024, the dollar surged 8% against a basket of global currencies. And asset managers slipped into a net long dollar position in December for the first time since 2017. But early this year, the dollar slipped 40 basis points, while the 10-year Treasury yield, which hit 4.8% in January, has since retreated to 4.54. Why? Well, because concerns over economic growth have overtaken inflation fears. While Trump initially threatened aggressive tariffs on Canada and Mexico, he granted both countries a 30-day delay, easing some market anxieties, but he didn't do the same with China and is now threatening Japan with new levies, particularly on steel and aluminum. What these moves have done is they've fueled uncertainty, leaving markets caught between fears of inflation and concerns about slowing growth. Despite initial concerns, emerging markets kind of doing okay. Chilean peso has gained more than 3% this year. Colombian peso and Brazilian real have surged more than 6% against the dollar since Trump's second term began. Bank of America strategists have actually turned bullish on emerging markets now, arguing the dollar strength has reached extreme levels and that much of the tariff risk has already been priced in. Now, while further escalation is possible, much of the market appears to have priced in current trade tensions, leaving room for potential rebounds in emerging market assets. However, with uncertainty still lingering, traders remain on edge as they navigate Trump's evolving economic agenda. I'm Lou Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You can find those at iTunes, Google Play, and Spotify, and while you're over there, we'd really appreciate it if you leave us a rate and review. Remember, we can help you better understand your portfolio dynamics, calculate your risk number, and optimize the potential for your 401k. Just head over to investtalk.com, click the portfolio review button. It is a free and confidential service. And while you're talking to us, maybe we'll even show you how we can build you a full financial plan. Independent thinking, shared success. This is InvestTalk. Good night.